We shall now discuss joint ventures. First of all, let us try to understand what is the meaning of joint venture, what are the different characteristics of joint venture, and how a joint venture differs from a partnership, and then we will go on to the accounting part of joint venture transactions. So, joint venture, as you all know, is a short duration business entered into by two or more persons jointly. So, there are two or more persons joining together to do a venture. It is generally confined to a single transaction. That means, whenever two or more parties join together, they are interested only in completing one transaction. It is almost like a temporary partnership between two or more persons without the use of the firm name and for a limited purpose. That means, here there is no firm name, unlike in the case of a partnership firm, and joint ventures are normally for a limited purpose to complete a particular transaction, share the profits or losses, and go away, each in their respective ways. And normally joint ventures are undertaken in businesses such as construction of a building, sale of some items, export of a particular commodity, etc. The persons who enter into such businesses are called joint venturers, or also called co-venturers. The co-venturers share the profit and losses of the joint venture on an agreed ratio. That means, before they start the joint venture, they will have an agreement among themselves as to how to share the profits and losses. If the agreement is silent, that means if the agreement does not make mention of the sharing ratio of profits and losses, then each of the co-venturers or the parties to the joint venture have to share them in equal proportion. Now, let us find the characteristics of the joint venture, also known as the features of a joint venture account. So, as we know, it is a short duration partnership for a limited or special purpose. Parties to the joint venture are called co-venturers. Co-venturers may contribute funds or supply stock from the regular business for running the venture. That means, instead of contributing cash, they may bring the capital in terms of kind. That means, they can bring the stocks which they are holding in their normal business into the joint venture. The co-venturers share profits at an agreed ratio. Profit and loss of the venture is generally computed on completion of the venture. That means, it is not done periodically, unlike in the case of normal businesses. If the venture gets completed, then the accounts will be drawn up. If the venture gets completed in 6 months, accounts will be drawn up in 6 months. If the venture takes 18 months, accounts will be made up for 18 months. Going concern assumption of accounting is not appropriate for joint venture accounting. This is a very important thing which you have to remember. So, in the case of basic concepts of accounting, we learned that there are three fundamental assumptions of accounting. One of them is a going concern concept. Based on the going concern concept, all the entities maintain the books of account. That means, all the assets and liabilities are recorded at their historical cost, on the assumption that the entity is likely to continue in the foreseeable future. But in the case of a joint venture, there is nothing like continuation in the foreseeable future, because as the definition says, joint venture is for a limited purpose and for a limited time. Therefore, the going concern assumption is no longer valid in the case of joint venture accounting. Therefore, all the assets will have to be valued accordingly. And since it is a limited period venture, there is no need to distinguish between capital and revenue expenditure. All expenses, whether they are revenue expenses or capital expenses, are taken to the expenses side, and all incomes, whether they are capital income or revenue income, are taken to the credit side, and then the profit and loss is drawn up for the joint venture. So, what they do is, whatever fixed assets are used in the venture are first charged to jointure account at cost. That means, it is treated straight away as an expenditure, and thereafter the assets at the end of the venture are revalued and then shown as the revenue of the venture. For example, let us say they have brought a particular machinery costing 1 lakh rupees in the venture. So, 1 lakh rupees is debited to the venture account as if it is an expenditure. At the end of 1 year, let us say the value of the asset is, let us say, 80,000. So, that 80,000 gets credited. So, in effect, what happens is, only the difference of 20,000, which is treated as the use of the asset, will be forming part of the expenditure of the joint venture account. Therefore, there is no distinction between capital and revenue expenditure, nor is there any distinction between capital and revenue income. So now let us try to find out the difference between a joint venture and a partnership firm. Though both of them look alike, there are a lot of differences between the two. So first of all, let us see what is the scope of joint venture, what is the scope of a partnership. In the case of a joint venture, the scope is limited to a specific venture. That means two or more parties are joining together only for the limited objective of completing a particular transaction. It could be an export, or it could be completion of a dam or a flyover or completion of a building, etc. Whereas partnership is not limited to a specific venture. It is a continuous business which the entity will be undertaking. And in terms of number of persons involved, the persons involved in a joint venture are called co-venturers, whereas the persons involved in a partnership are called partners. And in case of ascertainment of profit or loss, in the case of a joint venture, profit or loss is ascertained at the end of a specific venture if it continues for a short period. That means normally if it is over in a short period, at the end of the period profit or loss is ascertained. Whereas in the case of a partnership firm, since it is a continuing business, it is ascertained at the end of a particular period, normally on annual basis. At the end of the financial year, profit and loss will be ascertained. In terms of the act by which these are governed, there is no specific act which governs the joint ventures, whereas there is a specific act which governs the partnership firms, that is called the Indian Partnership Act 1932. So in case of a partnership, they have to fall in line with the requirements of the Indian Partnership Act 1932. And in terms of names, there need not be any name for a joint venture, whereas in the case of a partnership firm, there is always a name. The firm always is known by its name. And in terms of books of accounts, there is no need for a separate set of books of accounts. So if two people are joining together, each of them can continue to maintain the entries relating to joint venture in the respective businesses, or they can maintain separately. That means both possibilities are there in the case of a joint venture. There can be separate sets of books for a joint venture, or there need not be any separate sets of books for a joint venture. Whereas in the case of a partnership firm, there has to be separate sets of books. A partnership firm is required to maintain separate sets of books. Then admission of a minor. In the case of a joint venture, minors are not admitted, whereas in the case of a partnership firm, the Partnership Act says that minors can be admitted to the benefits of the partnership firm. In terms of accounting, as we have already seen, there is no going concern concept in case of joint ventures. So it is always done on liquidation basis. That means going concern concept is not taken into account. So the costs of all the assets or liabilities will be on the basis of liquidation. That means what they would get if the assets are sold, or what they have to pay if the liabilities have to be met today. Whereas in the case of a partnership concern, it is always done on a going concern basis, because a partnership firm is continuing in business in the foreseeable future. In terms of competition, the co-venturers can be competitors in their own businesses, and still they can form a joint venture and do business. Whereas in the case of a partnership, normally partners do not involve in competing business. If a partnership firm is doing some business, partners are not normally allowed to do competing business, that business which competes with the business of the firm. Now let us come to the last part of this, as to how to maintain joint venture accounts. So as we said, in the case of accounting, joint venture accounts can be maintained in two ways. One is they can have a separate set of books, or they can have accounting done in the books of the venturers only. So that means no separate set of books are maintained. Let us start with the first one, when separate set of books are maintained by the joint venture. So separate set of books means they are kept separately from the books of the co-venturers. That means co-venturers, if they are doing their own business, it will not be combined with the books of the co-venturers. So, there will be separate books maintained by the joint venture. In such a case, normally 3 accounts are maintained. One is called a joint bank account in order to route all transactions to the bank account, whether it is receipt of money or payment for expenses, goods, etc. Then will be a joint venture account which will take care of all the joint venture expenses and incomes, and a co-venturers account, that is the individual accounts of each of the co-venturers. So, a joint bank account is a separate joint bank account opened in the name of the joint venture, whereby the co-venturers will be making initial contributions. This account is normally operated jointly. It could be operated jointly by all the co-venturers, or in many cases it could be operated jointly by any 2 of the many co-venturers, depending upon the agreement between the co-venturers. The account is then opened with the cash or the contribution brought in by the co-venturers, and all the expenses for the joint venture are met from this account, and all collections, sales, etc. are deposited in this account. That means this account is used for routing all the transactions related to the joint venture, whether it is on the income side or on the expenditure side. And it is not necessary that everything has to be put through the joint bank account. Sometimes it may be necessary for the co-venturers to directly make payment or directly receive payment. That means some of the expenses could be paid directly by the co-venturers, and some of the income may be received directly by the co-venturers. And on completion of the joint venture, this joint bank account is closed by paying the balance to the co-venturers. Whatever balance is there, that is paid to the co-venturers. In the case of a joint venture account, this is particularly for the measurement of the profit of the joint venture. So, what is done is, it is just like a profit and loss account. All expenses for the joint venture are debited to this account. As I said, all expenses include both capital expenditure as well as revenue expenditure, because there is no distinction in a joint venture in terms of capital or revenue expenditure. And similarly, all collection sales, that is all income, whether revenue income or capital income, is all credited to this joint venture account. At the end of that, it will either show a profit or loss, depending on whether the credit side is in excess or the debit side is in excess. And then we have co-venturers accounts. These are the personal accounts of the ventures. They are almost similar to the capital accounts of the partners in case of a partnership firm. They are maintained in order to keep record of the contributions made by the co-venturer. That means they may have brought in cash, they may have brought in goods, or they have met the expenses directly, or they may have received the payments directly. All these are routed through co-venturers accounts. So, at the end of the joint venture project, the amount, these accounts will show as to how much money each co-venturer has to receive or to pay to the joint venture. So, this will then will be closed simultaneously along with the closure of the joint bank account. So, let us now try to find out how to exactly put through the entries when separate sets of books are maintained by the joint venture. So, let us start with the initial contribution by the co-venturers in joint bank account. That means, this is the money or goods brought in by the, this is the money brought in by the joint venturers and put in the joint bank account. So, joint bank account is debited and the co-venturers account is credited. That means, if it is brought by X, X account is credited. If it is brought by Y, Y's account is credited. And in case of expenses paid out of joint bank account, that means all expenses are made through the joint bank account. In that case, joint venture account is debited, because joint venture account is similar to a profit and loss account, that all expenses of the joint venture are debited to it and the bank account is credited. That means there is a reduction in the bank balance. So, bank account has to be credited. In case of material supplied by venturers or direct payments made by venturers, here they do not go through the bank account, because this is the payment made or material supplied directly by the co-venturers. In that case, since it is an expenditure of the joint venture, joint venture account is debited and the respective co-venturers accounts are credited. If X has brought in material worth, let us say 1 lakh rupees, then the joint venture account is debited with 1 lakh rupees and X's account is credited with 1 lakh rupees. And in respect of sale or payment received through the joint bank account, in which case joint bank account is debited because that is the money received, that is the income received by the joint venture, and it is credited to joint venture account because that becomes the income of the joint venture. So, it will go to the credit of the joint venture account. In respect of sale or payment made directly by the venturers, that means in this case the expenses are met by the venturers or the payment is received by the venturers. So, in that case what is to be done is co-venturers account is debited directly and joint venture account is credited. So, this is the income received by the co-venturers. And in case of profit on joint venture, whenever there is a profit in joint venture account has to be debited in order to close the joint venture account, and the co-venturers accounts are credited in respect of the profit made in the same ratio which has been agreed upon. So, as we have said earlier, if there is no agreement regarding the sharing of profits, it will be shared equally between the co-venturers. And for loss on joint venture, similarly, joint venture account will be credited, whereas co-venturers accounts will be debited with the respective amounts. That means all co-venturers will have to bear the loss in the same agreed ratio, and closing of the bank account is done at the end of the joint venture by crediting the joint bank account and debiting the amount lying in the bank account to the respective accounts of the co-venturers in the same ratio. So, this is how accounting entries are put in terms of all the transactions which are likely to happen in the case of a joint venture. Now, let us consider how to maintain books of accounts if there are no separate sets of books. That means the books will be belonging to the co-venturer separately. So, each co-venturer is required to enter his part of the joint venture transactions in his own books. So, here what is done is he will enter whatever concerns him, and whatever does not concern him is done through a joint venture account which he opens in his own books. So, each co-venturer will open 2 accounts in his own books. One is called a joint venture account, the other is the co-venturer account. That means if X is maintaining the books of the joint venture in his own books, he will have a co-venturer account of Y. That means the other person's account. That means whatever money has to be paid or to be received from the other co-venturers is opened in his books, and the following journal entries are passed. First of all, supply of goods to venture out of business stock. That means X is maintaining transactions in his own books and X is supplying goods to the joint venture. So, what he has to do is he has to debit the joint venture account and credit to purchase account, because purchases from his purchases he is supplying the goods to the joint venture. Supply of goods from market purchases, or he can purchase the goods from the market and straight away supply it to the joint venture, in which case he will debit the joint venture account and credit bank account, because he would have paid the money from the bank account. And if he pays expenses of the joint venture, in that case he will again debit the joint venture account and credit the bank or cash account from which he has met the expenses. And when the co-venturer supply goods, that means the goods are brought by Y and X has to reflect that in his own books. So, when the co-venturer supplies goods and incurs expenditure, it will again go to the debit of the joint venture account, but will be credited to the co-venturer's accounts. In this case, Y's account will be credited in the books of X by debiting joint venture account, and for the venture sale, whatever income is received, that will be credited to joint venture account and the bank account is debited, because the money is received by the venturer, co-venturer X. So, this is how entries are put through in the books of the co-venturer when separate sets of books are not maintained. Similarly, venture sale made by co-venturers, in that case co-venturer's account is debited. That means here the sale is made by another party. So, if sale is made by Y, X has to reflect it in his book. So, what he does is he debits the account of Y in his books and credits the amount to the joint venture account. So, thereafter the joint venture account will show profit or loss. That profit on the venture has to be transferred by debiting the joint venture account and crediting the PL&D account for his own share. That means that profit belongs to all the co-venturers. So X, if he is maintaining the transaction in his own books, only his share he has to take it to his account. The rest of the money has to be credited to the accounts of the co-venturers. So for co-venturer shares, you credit. So if for example there are two parties X and Y, X will credit his own share to his own PL&D account, and Y share he will credit to Y's account in his books. Similarly, loss will be again debited to his own profit and loss account for his own share and debited to the co-venturer's account in respect of the share of the co-venturer, and the amount is credited to joint venture account so as to close the joint venture account in his books. And if there are, then ultimately whatever money has to be paid or to be received from the co-venturer, depending on whether the co-venturer's account shows a debit balance or credit balance, then that has to be adjusted by passing adjusting entries. If the money has to be received or paid to the co-venturer, then co-venturer's account is debited and bank is credited, or bank account is debited and the co-venturer's account is credited, depending on whether money is to be paid or received. So with this, we come to the accounting transactions in respect of a joint venture.